Howdy, Jacob here. Today we're looking at Arista Networks. We see that they are in the communications equipment industry with an $83 billion market cap on 78.5 enterprise value. They develop, market, and sell cloud networking solutions around the globe. We're a very new company for it being $83 billion market cap, 2004. Okay, growth has been absolutely insane since 2013, over 10 times in a 10-year period. Return on invested capital has been very high along the way and has actually improved from 10 years ago. Gross margin, however, is down. So we see gross margin down a little bit, operating margin up a lot, 18% to 35% in the most recent year. So let's look at the balance sheet. So $1.89 billion in total debt, and all their liquid assets are about $3 billion. So extremely healthy balance sheet. Free cash flow statement, use of cash flow, a little bit of acquisition, purchases, a lot of reinvestment, and then a lot of common stock repurchases. Okay, I think that's fair. I think if I were this company, I would put a little bit. I mean, they don't have much debt. I don't know if they have any long-term. Okay, yeah, no long-term, no short-term. So they have the ability to leverage if they find an opportunity that's beyond their current cash, and it wouldn't be bad depending on, the percent of debt that they went into. But with this type of company, I mean, their use of cash, buying back shares when they're obviously cheap. I don't know if 2019, 2021, especially 2021, 2022, whether they were absolutely cheap, but different story. But really just look when they repurchase these. You want companies to be buying back shares when they're going to get excess return, making investments. Absolutely, that's a fantastic thing to do for a company with as high of ROIC as that, 30% in the most recent year, and then a little bit of acquisitions makes sense. If there's a company you can buy that already does the things you want, maybe you'll overpay for it in the short term, but over the long term, you'll get the return through excess margins or excess growth. So I think I'm ready to start making some assumptions here. I'm probably going to be more conservative than most for a lot of these things. It's just who I am, so keep that in mind. But the growth has been so immense in the past. They're already an $83 billion market cap, making $4.3 billion. I just think, I feel like 12% a year is pretty reasonable for that. And then, as for margins, their operating margins have gone up, so keep that in mind. Maybe I'll do 30, 32. Share changes, they've purchased a little bit, but let's look at stock-based compensation, already $280 million. So I would say that the shares are going to be relatively flat over a 7-year period. Maybe they'll buy back some, but they're going to dilute to share issuance to stock-based compensation. Terminal PE, let's do 20 and then 15% return. All right. Company's going to have to drop 66% for you to the return I'm looking for here. This is a fantastic company. I absolutely want to own it. I just want to own it at the right price. And again, I've said before that you own companies like this that actually do compound at 10+% a year revenue-wise over a 20-year period. If they're able to keep that consistent, it'll make up for buying it at a fairly frothy price. There's a chance that, if the company's growing 12 to 15% a year and you buy it at a 50p and it goes down to a 20p 20 years from now, you can still get a 12+% return, given the fact that the company's compounding on itself, and although you're getting a depreciation in P, the company's just grown so much. But for me, where I'm at right now, I just want as much return as possible. And for me, the return I'm looking to have greater than this 15%. But I would definitely add this to your list of fantastic companies to look at, and I hope you have a great rest of your day. Thank you.